If you're saving over $500 per month, or you're just sitting on a pile of cash and wondering where to invest your money, sit tight. I'm going to give you 3 ideas on where to park your cash in 2023, especially in this higher interest rate environment with talks of a recession looming. In fact, if you need to regroup, reset, and start setting some financial goals for the new year, comment goals below and I will hook you up with a free financial goal setting worksheet that will help you out with where to park your savings. My name is Michelle Hung. I'm an author of 2 investing books, The Sassy Investor and Investing for Teens, How to Save, Invest, and Grow Money. I am a financial educator and also fee-only financial planner, helping people build their 6- and 7-figure investment portfolio in the stock market. One of the first things I help my students and clients with is making sure their money is allocated in the most efficient way so they can earn the maximum returns and not just have their money sitting around doing nothing for them. But before you put your money to work, you have to know what the money is being used for and when. The key is when. So in the next several minutes, I'm going to give you 3 ideas on what you can do with your money based on your money being allocated to either short-term goals or long-term goals. If you need liquidity and want to just have your cash readily available, for example, this is where you want to put your emergency savings, then I would recommend a high interest savings account. Banks like EQ Bank are paying around 2.5% for just having your money sit there, and it's absolutely risk-free because it's a savings account. This is where you want to put your money for when you need immediate access to it. So things like an emergency fund, tax payments, anything that's due in the short term or require you to have access to it all of a sudden. Now, if you have a sum of money that you'd like to earn a slightly higher interest rate on, but you don't need access to it for at least 3 months, there are some GICs, which are guaranteed investment certificates, that are paying more than 2.5% per year and even up to a solid 5% per year on a 1-year GIC. Now, this is all thanks to rising interest rates. Before interest rates were so low, the returns were just so pathetic in your savings account. Keep in mind, however, that with a GIC, the money is locked in, which means you can't access to it prior to maturity or you'll get penalized on it. These are also risk-free like a savings account. GICs are great for earning some cash in the short term, that is less than 3 years, to ensure that you don't spend that money because your money is locked up. That's the key difference between a high interest savings account versus a GIC. So things like a wedding where a big payment is due in a year, or a down payment on a house or a car in the next 6 months, you get to earn a slightly higher interest rate than you would otherwise earn in a high interest savings account by locking your money in a GIC. Finally, if you want to grow your money and savings over the long term, anything beyond 5 years, now is a great time to invest that money in the stock market. When you're investing, you are not touching that money for a while. Adding some dividend-paying stocks or exchange-traded funds, ETFs, are a great way to maximize your returns for literally doing nothing, while setting yourself up for long-term capital growth and collecting dividends, which are profits from companies, in the short term. It's a double win right there. Now, if you're wondering, the stock markets have been so crap lately, and if there's a recession coming, won't stock prices go down further? Yes, it happens. That's the nature of the economic cycle. So many people are down on their investments this last year, and it's not specific to the stock markets. Real estate, cryptocurrency, bonds, so many asset classes are down. When stock prices are down, it's the best time to invest. However, there are some industries that have been performing well, like oil companies and staples like food. There are 3 things to keep in mind when investing in the stock market. Investing in the stock market is excellent for long-term growth. It's one of the best ways to grow money passively while you eat, sleep, and go to work. Don't look at the last year's crappy returns in isolation as an indicator of how your investments will grow. Your strategy is for the long term, so these short-term hiccups should not matter. The second thing is to keep a diversified portfolio so you're not heavily concentrated in any one particular industry like tech or oil. And this is because certain industries perform better than others depending on where we are in the economic cycle. Tech has had their reign, now they're suffering a bit. Meanwhile, other industries like oil and consumer staples are doing well. Being diversified saves you the time, energy, and effort from selecting, choosing, and timing when to buy and sell your investments. Staying invested for a long time with a diversified portfolio is the best way for your money to grow. And lastly, investing in the stock market has beaten inflation over the long term. So if you're worried about what to do with your money and you're concerned your money is going to be eroded by inflation, invest in the stock market. So high interest savings and GICs are both great for short-term needs. Goals for the long term, you should be investing investing your money in the stock market. Again, if you want a free worksheet on setting your financial goals, comment goals below and I will hook you up with a worksheet, no email required.